From 1985 to 1994, one hedge fund returned about 40% a year. Every year. Then the manager gave all the outside money back and published his entire strategy in a book anyone could buy for $15. Most investors still ignore it. That manager is Joel Greenblatt. The strategy he revealed, he called it the magic formula. And it has quietly embarrassed Wall Street for 2 decades. It's absurdly simple. It's been tested, published, picked apart in academic journals. And yet, it still works. Today you'll learn exactly how it works, the 2 numbers it runs on, and the one psychological reason most people abandon it right before it pays off. Joel Greenblatt isn't a household name. He probably likes it that way. But inside the investing world, he's a legend. He graduated from Wharton. Founded Gotham Capital in 1985 with about $7 million. 10 years later, that fund had compounded at roughly 40% annually, gross of fees. Let that sink in. Warren Buffett's long-term track record is about 20% a year. Greenblatt did double that, for a decade. Then in 1994, he did something almost nobody does. He returned all the outside investor money. Kept managing his own capital. Started teaching at Columbia Business School. And a decade later, he wrote a tiny book called The Little Book That Beats the Market. The whole strategy. Free, well, $15. Everything he'd learned. But here's where it gets really interesting, because the formula inside that book sounds too simple to work. The magic formula runs on 2 numbers. That's it. 2. Number 1, return on capital. This tells you how good the business is. How much profit does the company squeeze out of every dollar it puts to work? A high return on capital means you're looking at a machine. Coca-Cola. Apple. Moody's. Businesses with pricing power and moats. Number 2, earnings yield. This tells you how cheap the business is. Basically, for every dollar you pay to own the whole company, how much does it earn back? A high earnings yield means you're paying a bargain price. Now, here's the genius of it. Greenblatt didn't invent either number. Benjamin Graham obsessed over cheapness. Warren Buffett obsessed over business quality. Greenblatt just combined them and systematized the process. Rank every company by return on capital, best to worst. Rank every company by earnings yield, best to worst. Add the 2 rankings together. By the top 20 or 30 stocks. Hold for 1 year. Repeat. That's the whole strategy. A smart high schooler could execute it. And when you step back, it's Buffett's famous principle, written as math. Buffett said, buy wonderful businesses at fair prices. The magic formula just automates that idea. Quality plus value. The combination is where the magic lives. So does it actually work? Greenblatt ran the numbers. 17 years of data, 1988 through 2004. The results were uncomfortable for the financial industry. The top 30 magic formula stocks returned roughly 30.8% a year. The S&P 500, over the same stretch, returned about 12.4%. Here's what that difference actually means. $10,000 put into the S&P in 1988 would grow to somewhere around $73,000 by 2004. $10,000 in the magic formula would grow to roughly $900,000. Same starting capital. Same 17 years. More than 10 times the ending wealth. And this isn't cherry-picked. Academic researchers have run their own versions. Some have replicated the edge. Others have found smaller edges once you strip out tiny illiquid stocks. But the core result keeps showing up. A simple, mechanical strategy quietly beats expensive fund managers. Which raises an obvious question. If it's this good, why isn't everyone doing it? Here's the catch. The magic formula doesn't work every year. Not even close. Some years it crushes the market. Some years it lags badly. Sometimes it underperforms for 2 or 3 years in a row. And that is the hardest part of investing. Not finding an edge. Keeping one. Greenblatt himself has said something close to this: if the strategy worked every single year, everyone would pile in, and the edge would disappear. The discomfort is the price of admission. The fact that it's painful to hold during bad stretches is exactly why it keeps working. Most investors can't sit through that pain. They check performance every month. They read scary headlines. They get jealous watching tech stocks rip higher while their boring magic formula portfolio sits flat. And they bail. Usually right before the turnaround. This is the deepest lesson Greenblatt ever taught, and it's got nothing to do with math. The formula is easy. The discipline is hard. Any strategy, however brilliant, is worthless if you abandon it in the first drawdown. So here's the principle to carry with you. Good investing isn't about finding a secret. Greenblatt literally published his. It's about having the patience to let a simple, boring, sometimes disappointing strategy compound for 15, 20, 30 years. Price and quality, held with discipline. That's it. That's the whole game. The investors who beat the market aren't smarter than you. They're more patient than you. And patience in a world of instant gratification has never been more rare. As always, this is educational content, not financial advice. The magic formula is one of many frameworks, and no strategy works without your own research. Here's my question for you. Have you ever sold an investment right before it recovered? I've done it. Tell me about it in the comments, no judgment. It's how we all learn. And if this changed how you think about simple strategies, hit subscribe. Tomorrow, we're looking at a company Warren Buffett held for 60 years, and why he almost sold it 3 times. You won't want to miss that one. Until then, stay patient. Think long term. The market rewards the boring.